All right, everything looking good on my end. Should be going live. All right, let's go. Welcome back to the channel, Crypto Trend Trader, with our Sunday evening market look ahead. Before we get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. All right, gonna go ahead and jump right into it. Got a lot going on here, a lot to look at. Obviously, crypto is off to a great start for this daily close already. We see it is drastically dumping. So we had a little short squeeze there right at the end of the day. A little pop-up attempting to push back to the upside. Got rejected once again. So let's go ahead and jump into our crypto and take a look right now since it's moving. So if we just look at our daily right here, we see basically we have moved up to the 8 once again, attempting to push up. This is the Bitcoin chart, and once again gotten rejected. So we see this entire downtrend that we've been inside of since confirming with the 821 cross on November 18th. We see we've been unable to, let alone cross the 821 back to the upside. But with the exception of essentially like these 3 days right here, we haven't even been able to get on top of the 8 and maintain a close and then an open. So that tells me we know for a fact that as long as we're underneath that 8 moving average, we know we're going to be in a downtrend until we cross back above that and start to hold. And then the next step, we need to get above the 21, and then we need to stay above it long enough that the 8 crosses above the 21, and then we get our green cross again on the TJD Master. Once we get the green cross again, we can start assuming that we're going to get that reversion to the mean play. But in the meantime, this is the beauty of if this, then that. Knowing what needs to happen in order for the bull case to play out, or knowing what needs to happen for the bear case to play out, or, you know, whatever in between. Because the rest is just noise. Because the truth is, when we're looking at this daily chart, we can see that if every time we bought the green 821 cross, and every time we sold the red cross, and then we bought the green cross, and then we sold the red cross, what would end up happening? Let's just look at this, you know, in perspective really quick. Matter of fact, all right, I don't want to delete this chart, so I'm going to leave this up. So it might look a little bit messy, but just for a little mental exercise, let's just assume that we bought the green cross right here, and then we sold with the red cross right there. And let's see what that would look like. And we just say we did the same thing each time. So we bought that green cross, and then when this crossed up again, we bought that green cross. And then we'll say we did the same thing for the red crosses. So we sold this one as soon as it turned red. You know, it wasn't much, but at least we de-risk. We ended up getting back in around the same level, but we avoided the risk. And that's what the beauty of that is. So we know as long as we are crossed down, as long as we still have this 821 crossed to the downside right now, we really have no interest in a daily long position. We have no interest in a swing trade. We have no interest in, you know, an investment, because we know in order for this to ever be investable again, in order for this to be worth trading, worth entering into a long position on a daily time frame that's substantial, we know we need to see that 821 cross back to the upside again. So that's a 100% definable thing that we can tell. And I think the problem is, I know the problem is, what a lot of people have trouble with is distinguishing those things. They can't, if I told you, I want you to write down in 3 sentences, I want you to write 1 paragraph and tell me what you're going to use to enter a trade or an investment, what you're going to use to exit a trade or investment, you know, and basically just sum it up for me. Just give me the basics that anyone can understand. Most people can't do that. And that's the problem is, if you can't clearly define it to yourself, if you can't clearly define it ahead of time, then how are you going to know when to get out? How are you going to know when you're right? How are you going to know when you're wrong? Well, you'll know when you're right, obviously, because you'll be sitting there saying, damn, I'm a fucking genius. But how are you going to know when you're wrong? How are you going to know when to bail on the trade? How are you going to know that you made a bad decision, get out, reassess, and then you could start over? And that's the beauty of it. You need to figure out what works. You need to figure out what's going to work for you. All crypto go up 500 EMA, bro. Yeah. Good luck, dude. Oh my God. But anyway, let's actually look at this. So we know for sure when the 8 crosses to the downside below the 21 and the TJD master flips into our red and pink, we know that there's no reason to be in that because we can't be going up. And we know that until the 821 crosses back to the upside, there's no reason to be in it. Once it crosses to the upside, we take a scalp to the upside. The same way that when it crosses to the downside, if we're in a downtrend, we take a scalp to the downside. So how do you know the probability of success on one of these trades? How do you end up with one of these winners like this one right here? This is what the whole game is all about. These are the ones we want. The little ones, the little wins, the little losses, who cares? They could balance each other out. We don't care about those. The big losses, we don't want those. We want to get out of those. But what are we really looking for? This is why we play the game right here. The big wins. That's the whole reason we play this game, is for these right here. For these wins. So we take the little wins and the little losses, they cancel each other out. We avoid the big losses, and then we get the 444% wins. That's why we play the game. So how do you figure out when you're going to get these big wins compared to when you're going to get the big losses? It's easy. It's easy. We have to have a trend identifier. So we know we're never going to get a big win in a bear market. We're only ever going to get reaction rallies. And we know we're never going to get a big loss in a bull market because it's going to get bought up every time. So the key is now we've already defined our 821 cross as our short-term scalping or entry point on this daily time frame. And we know that this was big wins. This was a decent loss, but not too bad. And then we see here we started oscillating between the two. So what is that telling us? Well, this was our bull market right here, and that's when we got that big win. And how do we determine the bull market? Well, we look at our 200 exponential and simple moving average. Okay, so as soon as we cross back above the 200 exponential and simple, and we see right here is when the cross took place. So now we can identify that clearly as this is our entry point into a bull market. This is where we transition into the bull market and it started. So from here on out, we should be buying the dips. Every dip should be bought. We shouldn't be looking for short positions. We should be looking for long positions. So if this is our buy right here, this is our entry into long positions. We could see afterwards we had a little boom to the upside, little green area. You know, didn't work out great because obviously right afterwards we had the 821 cross back to the downside. Then we had a big move right here. This is what we want. So this little win right here, this little loss right here, we don't care about those. I mean, they're great, sure. This is what we care about, this big one right here. So now we need to figure out, we know how to determine the uptrend. How do we determine the downtrend? Because this looks like, to me, we're chopping around here. This looks like chop. You know, we have the big win, but then look, this is a pretty big loss. Now we avoided it. We got out right here. So we dodged, by using this strategy, we dodged a 43% loss. We got back in. And everybody knows we got back in for bullish divergence off those 3 drives. Same reason we had bearish divergence off these 3 drives. We got back in for another 40% gain. Then we got out. Then we got right back in. But at least we didn't get chopped up. We didn't lose because we got out in time. And then the next move was that push up right here. And then we got back out at 60. It was like 62,000, something about that. Another 30% win. But more importantly, we dodged, so far, a 44+% loss. Now, are we getting right back in right now? No, we're waiting. We're waiting because we know what needs to happen before we get back in is we need a daily 821 cross back to the upside. And we're not even close to that happening right now. We're not even close to that happening right now. So the next thing that needs to happen for this to be bullish is the 821 crossing back to the upside. But now remember back here when we had that blue cross, when we got back above the 200 exponential and simple, when we reversed this trend back to the upside and we confirmed that it was a bullish trend and now we want to be taking longs, we want to be buying the dip. So how do we know when we're entering into a bear trend? Let's look right here. I'm going to get rid of this box for just a second just to clear this up a little bit. We see the same thing happening but in reverse right here. We see now the 200 exponential has flipped over from this bright blue to red. We see the 200 simple has flipped over from this dark blue to pink. So now that is a confirmation in the opposite direction. The same way that we confirmed when both of them flipped bullish, and that was our bull trend starting. Now they have both flipped bearish, and that's our bear trend. Oh, I clicked the wrong thing, sorry. Hang on one second. So the same way we confirmed the bull trend and we got that massive move to the upside that we took advantage of way back when nobody was paying attention to the crypto, same way we crossed and confirmed clearly now. We can see in hindsight, but we don't need to look at it in hindsight because, you know, obviously we were involved in the markets back here. So we can just look back at what we were doing. But here we obviously had a hard buy. Now it's buying the dip. But buy every dip. Buy the dip. Buy the dip. You know, buy the dip. Buy the dip. Come in here and we're waiting to buy the dip. But now something changed. Now we're below the 200 exponential and simple. So the slope is to the downside. So we don't know for sure that we're not just going to bounce right back up here and get back on top of the 200 exponential and simple. And they're going to flip over blue. And then we're just going to go into a massive bull rally and it's going to go to $250,000. We don't know that that is not going to happen. We do not know that we're definitely going into a bear market right now. We don't know that. We don't know anything for sure in these markets. All we can do is figure out probability, and we can look at what tells us, what precludes the big moves to the upside and the downside. If this happens, then this can happen or will happen or needs the A needs to happen before B can happen. So we know that in order for a massive move to the upside like this to happen, we need to cross above the 200 exponential and simple. In order to cross above the 200 exponential and simple, we need to have the green cross of the 8 and 21 to the upside. So we know for sure, if we're ever going to have a big win in any market, we need the 821 to cross to the upside above the 200 exponential and simple. We need to have a blue slope on the 200 exponential and simple. And then the probability of a massive upside move like this is much, much higher. And in order for a massive move to ever happen, those things all have to happen first. So now the same way we look at this right here, in order for there to be a massive sell-off, you know, 50%, yeah, that sucks for sure. It does for sure. So to dodge those, we dodge the 821s. But once we flip this bearish to the downside, once we have this happen right here, we've officially confirmed a bear market. So now we know that instead of buying the dips the same way we were in the bull market, we want to be selling the rips. So what does that mean? Well, when we're buying the dips, we're waiting for pullbacks, and then we're adding to our positions on pullbacks off of support. So when we enter into a bear market, now we want to sell the rips. So every bounce, every move to the upside, every push back up and attempt to break out bullishly, we want to sell into it, either positions that we still have open or short positions, etc. Because we're expecting further downside. Now, what determines if we're wrong here? Well, we know. We already know. We talked about it. The 8 and 21 have to cross. We have to see the green cross back to the upside. So I'm going to get rid of all the drawing tools. Now let's look at it again. So we know we need this green cross to happen where the 8 crosses above the 21, this flips green, and then we could potentially get back up here. So once that happens, we could potentially enter into a long position. Now, do we want to do that? Not really, because we're still below the 200 exponential and simple. So we can enter into a scalp position. We can enter into a quick little maybe swing trade, but we want to be ready literally to get back out as quickly as we got back in, because in all actuality, our mentality has changed now. Now it's sell the rip. It's not buy the dip any longer. So if we do get a push back up, what's the likely thing to happen? This is our reversion to the mean trade. The retest of the 200 exponential and simple. The attempt of the bulls, of the cult, whatever it is that you're looking at, they're going to attempt to push the price action back up and get back above the 200 exponential and simple. More likely than not, it will fail and then we'll continue to the downside. Is it possible that we reclaim this level? Yes. But in order to reclaim that level, what has to happen first? The 821 has to cross the upside. So we need to have the green cross. And then let's say the bulls start taking over. And then we get back above the 200 exponential and simple. And then they flip back blue. Then what? Then we can potentially get another one of these moves like this. But we know for a fact that in order to get a big move to the upside, in order for Bitcoin to go to 100,000 or 200,000 or $1 million, whatever FOMO dream we have out there, in order for that to happen, we know for a fact the 8 and 21 have to cross to the upside, and then the 200 exponential and simple have to be reclaimed, and then the slope has to flip back to the upside. So until those things happen, anyone that is saying Bitcoin is going to new highs, anyone that is saying that crypto is going to put in new all-time highs, or 100,000 or 250,000, or that we're still in a bull market, those people are dumb. They don't have a functioning brain based on technical analysis. And that's a fact, because we know for sure that in order for there to be a bull market, in order for there to be new all-time highs, those things have to happen first. So as the 821 cross back to the upside, we can start to get a little bullish. As we reclaim the 200 exponential and simple, we can start to get much more bullish. And then somewhere around this area at 47, 48, 49,000, if we reclaim these, the slope flips back to the upside, then we can start say, okay, hang on, we might be about to do this thing. The same way that right here, we weren't biased. We had the cross to the downside, and then we reclaim those levels, and we say, okay, we might be able to do the damn thing. But that's not always going to be the case. And in order for it to be the case, we have to reclaim those levels first. Now let's look back at the previous history. So this is the Bitcoin futures chart. So it doesn't go back as far, but we know that this cross happened right here and entered into a bear market, basically at the all-time high in 2017, cycle high. And then after that, we saw 80-something% move to the downside. And we noticed the entire time of the move to the downside, this 200 exponential and simple was red and pink. So in order for that bear market to end, in order for Bitcoin to enter back into a bull market, what had to happen? Well, we already know. We just talked about it. The 821 had to cross to the upside. So here we get a little bullish. But we're still underneath the 200 exponential and simple. So once we get back up there, we start getting a little more bullish. Then we reclaim these levels. Then what happens? Oh, look. The 200 exponential and simple have officially crossed back to the upside. So now that's our bull market indicator. We're back in a bull market. Game on. Instead of selling the rips, we're buying the dips again. And then look what happens after that. We get a nice little run up right here. And then we get the 821 cross to the downside. Get out, get in, get out. Starts getting a little choppy. But we dodge this whole move to the downside. And then we start finding support right here. And then what happens again? Break back down here. Don't flip the 200 exponential and simple back to the downside. Reclaim those levels. And then look what happens here. Right at the CVD dump. What happens right here? Confirmed bear market once again. Right before the big dump. Confirmed bear market again. Right before this massive sell-off. So by just getting out of that position at the 821 at the 200 exponential to the downside, we dodged out another 60% downside move. And then what happened again? 821 cross to the upside. We start reclaiming these levels and then bull market confirmed. So we're not going to, this is, a little choppy, whatever. Maybe we got chopped out a little bit right here. We missed out because we broke even on a buy and then we broke even on a sell, whatever. But we dodged the big dump right here because we got out before the bear market. We dodged the big dump right here because we got out before the bear market. We capitalized on the bull market right here because of this indicator. Now, again, maybe we got out at the 821 cross right here, 100% move to the upside. Here we got the, what was that, 400 and something percent move to the upside. 442% move to the upside. That's what we're looking for. We're looking to, this is where we make all our money. The other stuff is just noise. So if we dodge blowing out our account because we ended up in a bear market and lost 50% or 75% or 100%, if we dodge those, and then we get chopped up a little bit on some of these intermediary moves, which these are big enough that we made money on them anyway. And then we just get these big ones. That's all we need. That's all you need for good investments to make money over time. But you're not going to get them every day. But we know right now by what's happening. And I'm only doing this deep dive because people had asked me about two specific things: determining trend and divergences. So we're going to talk a little bit about those. And then we're going to get into the stock market and everything. And we're going to talk about why I'm so skeptical about everything that's going on right now, because we're seeing the same thing in the stock market. So Bitcoin has confirmed into a bear market right here. So can it reclaim these levels? Yes. But the most important thing is we are out. We're sitting on the sidelines eating popcorn right now. Okay. Because we're dodging the bear market. Because we know for a fact, in order for there to be a bear market, this has to happen first. This cross has to happen first. So does it mean we're going to go into a big long bear market? Does it mean Bitcoin's going to go back to 20,000 or 10,000 or go to zero? No, it does not mean that at all. But it does mean for a fact that in order for there to be a bear market, this has to happen first. So we're out of the way right now. Now, if we see this cross back to the upside, 821 cross, we can get a little bullish. We can take a little scalp. We can make money off that reversion in the mean play. Let's say literally tomorrow, Bitcoin just shot back to the upside and got back above that 21 right here. 10% move to the upside. Started consolidating, and then boom, all of a sudden the 821 cross back to the upside, and then we get a retest of the 200 exponential and simple. What does that look like? I mean, it looks like roughly another 12% move to the upside or something like that. So it's nothing crazy. 10% to the 21, another 12% back to 200 exponential and simple. So 22% move to the upside. So what if we just skip that? Sure, we could skip it. And then what happens if we consolidate here long enough? 200 exponential and simple start to roll back over. They flip bullish, and then we go back into a bull market, and then we can bust our nut. We don't need to worry about some bullshit little 10, 12% move to the upside. When we know that if we get that cross, we're looking at 100%. We're looking at 400%. We're looking at 1,000% on some bullshit little altcoin that I've never even heard of. But who cares, because it's a bull market. That's what we're looking for. And that's why it's so important to be able to determine trend and be able to tell yourself, tell, a child, tell your wife who has no interest in these charts or anything. If she goes, you go, honey, read this paragraph that I just wrote down for you, okay? And then look at this chart with this little indicator on it, and you tell me where you buy and where you sell based on these, this paragraph that I wrote down for you. Literally a child could look at this chart and do what I just told you, what I just explained, what I just said. So that means literally a child could probably beat 75% of traders out there because you have defined the guidelines. You have defined your entries and your exits, and there's a legitimate reason why those work. So now we know we want to be out of these markets sitting on the sideline and waiting because we're de-risked right now. We're not going to take a chance because could this happen right here where we get just this little, 50% dump and then all of a sudden we go back to a new all-time high? Sure, it could. It could definitely happen. And that's what I hope because bull markets are way easier than bear markets. It's way easier to make money when something's going up than when it's going down. Like you can only short something down 99% before it goes out of business. But we know for a fact this was a 100% move to the upside. This was a 400% move to the upside. So all we got to do is dodge the big losses and then just wait for the big wins. So that's what we're waiting for. We're patiently waiting to just get that big win. Okay? I'm going to jump in the chat here real quick, and then I'm going to talk about divergence for a minute, and then we're going to go from, we'll look at some, actually, we're going to just go straight from Bitcoin over to the stocks, to the main indexes, and then we'll actually come back to the shitcoins. All right. What is going on over here, dude? 52K, all crypto go up, 500 EMA, limit orders. Dude, what are you talking about? Mark says, measure it out then, Mike. Mike says, that's easier. You're right, though. Do nothing. Hopefully you TP. I don't know what the hell's going on over there. All right. Yeah, yeah. Oh, yeah, I know, dude. Mike says, so the first 200 EMA shows future bear market, possible bear market. Very predatory. Dude, I don't know what you're talking about, Mike, but I think you're smoking the good stuff, dude. Mark, the reason I use the 200 EMA and SMA is because many traders use those. Traditional stock market analysts will use the 200 simple moving average, and then most crypto players or more volatile assets will use the 200 EMA. So I use both of them, and then I use the slope of them. Some people just use price action based on their relative position to the 200 EMA and SMA. So a lot of people will say, oh, as soon as we cross below the 200 EMA and SMA, it's a bear market. But I don't do that. I wait for the slope to flip. And that's why I designed this indicator, that once the slope flips, it turns them the other color. So we know the trend is now bearish. And it just makes it so much easier. You can flip through 100 assets real quick. You can tell what's going on. There's no doubt in your mind. Your brain sees it and goes bear market, instead of just having to wrestle with, what's going on. And then the 821 are basically used for scalping or early entrance and exits. But the blue ones that turn red and pink, that's for trend. And then the green ones are for entry and exits of, what could be either a scalp play, if you're trying to just, pay for your weekly expenses, versus, a swing trade, which is if you're trying to, buy a car, versus an investment, which is you're trying to retire. And that's basically the 3 time frames and how I break it down. Oh, I got you, Mike. Yeah, I don't know. When you said very predatory, I don't know what your long candles. I don't know. It just, yeah, okay, I got you. But anyway, so that is trend. That's what we're looking at. And then obviously we have our other indicators down here as well. I've been through these countless times. The TJD, TDMACD, and Jewel Thief. You guys know you can get pretty much all of my indicators for free on TradingView, with the exception of the TJD Master and the updated Jewel Thief. So the old Jewel Thief is available for free. The TJD TDMACD is available for free. I have other moving average indicators available for free, but these ones are exclusive to the group members for showing your support. So now I want to talk about divergence because that was requested by one of the group members as well. So we're just going to scroll over here and we're going to take a look at this price action and how we called out the exact top on Bitcoin. So this is, I'm going to give you the short version of it, but basically what we're looking for with divergences, and the reason we call it divergences, is it's a divergence between what we're seeing on the price action and what we're seeing on our indicator oscillators. So ignore the moving averages now. We're not paying attention to those. All we're looking at is comparing like one peak on price action to another peak on price action. So we see here we have a high. Then here we have a higher high. These two peaks are higher than this peak right here. Then we see we have another peak right here that's higher than the previous two peaks. So we have a high, we have a higher high, then we have a higher high than that. 3 consecutive higher highs. And then we see here corresponding to those peaks. Here we have a high on our indicator oscillator. Here we have a high on our indicator oscillator. And then here we see where the blue line is. We see here we have a lower high. We see here where the green histograms flip over. Here we have a lower high, and then we see here once again where the blue line is, we have a lower high, and then we see here where the green histograms are, we have a lower high once again. So I'm going to zoom in on these points now so it's a little more clear. So what we're looking at here is basically this. Well, actually, you know what? I'm going to do it with the arrows so it's a little more clear than the line. We see here, that's our first high. We see here we have a lower high than the first one. And then we see here we have a third, slightly lower. Equal high is fine too, but it's slightly lower. But we see here we have 1, 2, 3 consecutive lower highs. But here on price action we have 1, 2, 3 consecutive higher highs. And now if we look at the TJD TDMACD, we see the same thing very clearly once again. Here we have our first high. Here we have our second high. Here we have our third high. And each of these, we have a high, we have a lower high, then we have a third lower high than that. So again, that's called bearish divergence. And what it means is, it means that the price action keeps going higher, but we're not using the same amount of energy or momentum to continue moving to the upside. So what it tells us is that it's not sustainable. So if it's not sustainable, we expect that at some time in the near future, if it's not sustainable, price action will at least reverse temporarily. So what we look for typically is 3 drives of bearish divergence for a topping. And we see here, obviously, on that third drive of bearish divergence, we get the hard sell signal, we get the 821 cross right here. And then what happens after that? That was our top. So if we just got out at the 821 based on 3 drives of bearish divergence, we know that, sorry, should have scrolled over first. We know that from that cross to the downside right here, you could go to the wick right here. We could go to the wick right here. We could go to the bottom right here. We could go to the 821 cross back to the upside. We're going to just stick with what we do, which is the 821 cross to the downside is bearish based on triple bearish divergence, then the 821 cross to the downside, and then we're going to re-enter on the 821 cross back to the upside. So we avoided a 42% dump. So while all the Bitcoin dumbasses, while all the little crypto cucks were all pumped up and excited and Bitcoin's going to new highs and this is it and I'm finally going to be able to move out of my mom's basement and Dogecoin millionaire and this is it. While they were all super excited talking about, how they were going to buy a castle and all this stuff, we were getting out of the market because we knew the potential was that we were going to go into a long downtrend or potentially a bear market. Okay. So when that happened, we start looking at the 200 exponential on simples as our key next level to pay attention to. So we had triple bearish divergence. We get a pullback. We're still on top of the 200 exponential on simple and they didn't flip over bearish. So we're still looking for opportunities to buy. So the same way we were looking for opportunities to sell right here at the 821 cross, here we were looking for opportunities to buy. So here's the 821, but what precluded that 821 move to the upside? Well, let's look here again. What do we see here? We see a low right here, then we see a lower low right here, then we see a third lower low right here, or a fourth lower low right here. Depending how you're looking at these, we have essentially 4 lower lows based on our daily candle closes. So then we start looking at our actual divergence, or looking for actual divergence on the chart, and it's not as clear on the futures chart. It was much clearer on the spot market chart. But essentially what we saw here was an initial push down, then a lower push down, then a higher push down, then we actually saw a lower push down once again. So we see between this point and this point, this was a low, this was a higher low, and then that was a lower low. And then keep in mind, this is at the green one right here. This is just after the pink one right here. So here we see from those points, that was our push down right here. Then we had another push down, which was this area right here. So this was a low, that was a lower low. This was a low, that was a higher low. And then we actually saw a lower low on price action and a lower low on the indicator oscillator. So we saw some bullish divergence developing here. Not as clear on the futures chart, but we actually saw it very, very clear on the spot market chart. And then once again, we see one drive down here, very low. Then we see one drive here, less low or higher. And then we see a third drive down here, higher than the previous one. So we have a low here, then we have a higher low, then we have a higher low again. And we see we have a low here, then we have a lower low here, then we have a third lower low here. So we saw triple bullish divergence the same way we saw triple bearish divergence. So now we know that that's unsustainable. So we're looking for a potential entry. And what is our entry? The 821 cross back to the upside. And what resulted after that? Another beautiful move back to the upside, which we were able to capitalize on, which was another 38%. And the 821 cross back to the downside, we get back out, buy support, 821 cross back to the upside. So that's all we're doing. We're just getting out of the way when the market tells us there's danger. We're stopping at red lights, sitting on the sideline, watching the semi-truck T-bone the other idiots that drove through the yellow light. And then once the light turns green again, we get back in. We go. We drive through the intersection safely. That's all we're doing. So right now, what are we doing? We're at a red light. Doesn't mean we're not going to go again. Doesn't mean we're not going to cross the intersection. It just means right now we're seeing people getting T-boned left and right, and we're sitting in our car, okay, with a bag of popcorn in our hand, and we're eating it, and we're just watching all these morons make fools of themselves. We're watching people literally get murdered left and right, getting T-boned by semi-trucks. And that's fine. You know what? Because we come on here and stream all the time and try to save them. But if they don't want to stop at the red light, that's all we can do. All we can do is tell them, hey, that light's red. If they don't want to stop, that's up to them. They want to listen to, some dude who's talking about on-chain analysis or, reading the stars or tarot card decks or, drawing random patterns or talking about lengthening cycles. But they can't define any of this. They can't tell you when they get in and when they get out. They couldn't tell you there was about to be a 50% dump. They couldn't get you out for this. They couldn't get you in for the hundreds of percent because it's not clear and it's not definable. It's not reliable. And that's the difference between us and them. If you want to do this for a long period of time, you want to trade, you want to invest, you want to make money for a long period of time, you need to have definable ways to determine if you're in a bull trend or a bear trend, when you're going to enter, when you're going to exit, why you're buying into a trade or an asset or whatever, why you're selling out of a trade or asset or whatever, how you know if you're right, how you know if you're wrong. That's the key. And then we use things like divergence. We use things like momentum. We use things like our indicators and oscillators to tell us otherwise. But the main thing, the number one thing that you need to do is first determine the trend. Why do you determine the trend first? Because the likelihood of success, if you trade with the trend, is better than 50%. So if you're going to flip a coin with somebody and they tell you, hey, I know a trick, and if you do this trick, you have a better than 50% chance of calling that coin flip correctly, which is obviously not possible, but for this analogy it is. And you say, okay, yeah, what's a trick? And they tell you, well, if the coin is flipping heads up on the initial flip before it flips, you have a 10% better chance that you're going to call it correctly. And you're like, oh, okay, so if the head is already up, whatever. That's what our moving averages are for. They're giving us a slight advantage on that percentage chance of being right. So when we buy into a trade, we have a slightly better chance than 50% of being right because we're trading with the trend. So that's why we buy the dips in an uptrend because it's more than likely going to keep going up. That's why we sell the rips in a downtrend, because it's more than likely going to keep coming down. And when the trend flips over, we flip over too, because we don't care. I don't care about Bitcoin. I don't care about Shibcoin or Dow Jones or none of I don't give a shit about them. I don't give a shit about Netflix. I don't care about Peloton. I don't give a damn about any of those things. You know what I do? I care about money. I'm here for the money, okay? Because betting on Peloton, because I like their equipment or they have a good brand, is not going to make me money. And you know what? If Peloton loses 80-something% of its value, Peloton doesn't give a shit about me. It's not going to call me up and say, hey, I'm sorry, man, stick with me and I'll feed your family. I'll take care of you. You know, I'll pay your rent this month while we get things back together. Peloton doesn't care. Bitcoin doesn't care. So you need to worry about your damn self first and not get married to assets. And that's what the trend is for. So we can say, hey, I love Bitcoin. I love the idea of it. I love being your own central bank. But at the same time, you know what, Bitcoin? When you go into a bear market, fuck you. I don't even know you. And that's what we're doing. That's what it's all about. And then after that, once we up our probability of success by trading with the trend, then we can determine, you know, we can rule out those big losses. So now the only thing left is small wins and small losses and big wins. So if we got rid of the big losses, now the little wins and the little losses can cancel each other out. Who cares? They're a wash. And then the only thing left is the big wins. And that's what we're here for. We're here for big wins. Because I don't care if I make $100 or, you know, a couple grand or whatever. We're not doing this for pennies. Most people are trying to make a living off this or retire off of trading or investing or whatever. So if you can dodge the big losses, you can make the big gains. The other stuff doesn't matter. So, all right. So that's it for divergence. That's it for trend. I'm not going to go into depth on the other indicators today. We're just going to flip over to our traditional markets and take a look at those. And we're going to talk a little bit about what's going on there. And for you guys that are in the group too, in the trading tools, there's a list of divergences, how to identify the different divergences, whether it's a like with the trend or a counter trend, like if it's going to be a reversal of either an uptrend or a downtrend, if it's going to be a continuation divergence, you know, the different divergences like hidden versus regular, all that stuff's listed off in there. It's a resource you can always use, you know, stuff like that. Print it off, make it your home screen, make it your screensaver, put it on your wall. I mean, kiss it goodnight before you go to bed. I mean, whatever you want to do with it, but there's a reason that I have that posted up there. It's a very nice tool that everyone should have. All right, let me go say what's up to the bots real quick, and then we'll keep moving. What's up, body thotty? All right, so we got one bot. That's it? Only one? Don't worry. The rest will come. If you stream it, they will come. Smoke the best shit. Yeah, okay. Anyway, I like the way you think. You have a good grasp. I do, sir. How do you join the group? You can just message me. It is a paid group. CW says, thank you, brother, for sharing tonight. We'll have to cut out early as I need to push code to production. Would rather hang out. Yeah, for sure, man. Appreciate you always being here. Good to see you. Good luck with your pushing code into production. Hopefully you're not building some AI code that's going to wipe out the human race. Although at this point in time, it might be better off. All right, so let's jump over to our traditional markets. And I'm going to skip through the 10-year treasury real quick. And we're just going to compare this with what's going on in our traditional stock markets right now. And again, why I am, you know, cautious at what's going on here. So let's scroll back a little bit and let's look at, let's start right here. Let's use my method and see, how did I know that the stock market was getting ready to crash right before CVD, before anybody else knew about it? How did I know that the plague was coming and the stock market was about to get wrecked? Well, I just explained it to you. So we know here, look, 821 crossed the downside. So now we're cautious. We break below the 200 exponential and simple. Okay. And what happens after that? Reversion to the mean. We push back up. We attempt to save the trend. So what happened right here that we just talked about? We're not saying, I wasn't saying 100% that the stock market's going to zero. I wasn't saying that, you know, the whole world's going to end and we're going to go into a multi-year plague that shuts everything down and changes the world and life as we know it. I didn't know all that. But what I did know is I knew that in order for us to go into a bear market and have a massive sell-off on the Dow Jones Industrial Average, that first 821 had to cross the downside, then we had to close below 200 exponential and simple, and then the slope had to flip over to the downside. And then after that happened, what was the resulting thing? 37% dump. 37% of all people's value in all their retirement funds and the entire, arguably economy of the United States measured by, the Dow Jones, obviously like largest companies that are publicly traded, was cut right off the top of their heads. So, I mean, it worked. Got us out of danger. Kept us out of the way. And then in order for us to be bullish again, what had to happen? Well, we know the 821 had to cross back to the upside. That was a prerequisite in order for us to be bullish again. But we were still below the 200 exponential and simple. So really, we should be selling the rips, not buying the dips. But if you were bullish on the stock market, because it always goes up, and you wanted to take an early entry, we could have got back in at 22,300, which we did. And then what happens after that? Well, we eventually get the retest of the 200 exponential and simple. We burst back above it. We consolidate around that range. And then what happens? Not too long afterwards, right here, we see the 200 exponential flips back over bullish. 200 simple flips back over bullish. And what is that? Confirmed. Bull market confirmed. And then what happened after that? What happened after that bull market confirmed? Well, move to the upside. We come back down. You could get out right here. You could get back in right here. You get out right here. You get back in right here. But the whole time, what happened though? We maintain above the 200 exponential and simple and the slope all the way up into this massive 2-year bull market. So this little dot right here was like the, hey, let's start paying attention because this might be it. And then this was the like, oh yeah, this is about to be it, baby. And then what happens after that? Our big win. This is what we're in the game for. This is it. Okay? So we start participating in the markets right here. And then what happens? That's the big win. That's what we're looking for. That's why we play the game. For the grand slams. We're not playing for little singles. You know what I mean? I'm not bunting. We're here for the big game. 37%. Obviously, it's no crypto win, but, it's the Dow Jones. It's stable. And then what happened after that? Well, we get all the way up here and we see the 821 cross into the downside. But what's going on right here? We're now below the 200 exponential, trying to save the trend. 200 simple is almost flat. The slope is about to flip over red on both these. So this is danger zone. We need to pay attention right here. One of two things are going to happen. I mean, we could chop around for a little while, but eventually one of two things is going to happen. We're either going to close back on top of this 200 simple moving average. We're going to cross this 8 and 21 back to the upside. This is going to turn green. These are going to stay blue. And then we're going to go up and go to new all-time highs. That's option one. That's bullish option. That's the good option. Or the bad option is this. Same thing again. We see this happen. We see the red cross, 200 exponential and simple roll over. We go to the downside. We get out of the way. And then we wait for our next opportunity to get in. So right here, this is danger zone. If we close below 34,500 for too long, which is not, there's not a lot of time left, this is going to roll over. We can see the slope on this line. This 200 simple, the 200 exponential already flipped over red, and it was only this one day of price action that flipped it back over blue. So we know that it literally takes one day of price action, either up or down, and that's going to flip back over. So we know this is already just waiting. But now look at this. Look at the slope on this right now. Okay? I'm going to delete this now, just so it's a little easier on the eyes. Matter of fact, you know what I'm going to do? No, I'm not. So we see right here, this is the 200 simple coming up here. And now I drew a horizontal line right here in green. You can't even see the 200 simple right here. Where'd it go? Because it's that close to flipping over bearish. Because it's literally a horizontal line right now. It just hasn't quite flipped over yet. So what's that telling us? It's telling us now is literally the most dangerous time to be involved in these markets. Because we have already flipped the 200 exponential bearish. We saved it, but barely. We're below the 200 simple, and it's very close to flipping over bearish. So we know that if this confirms to the downside, we're going to put one of those red circles on our chart, and then we got to worry about where's this going. Is it going down 20%? Is it going down 30%? Is it going down 50%? Is it going down 80% like all these crazy ass people say? Who knows? Who knows? But what we do know is that this is when we don't want to be in the market. Because in order for a big loss to happen, This has to happen first. In order for there to be a big loss, this red circle has to happen first. So if we just get out of the way right now, there's no chance of us taking a big loss. But if we don't, we definitely have a chance of taking a big loss. But all we have to do is avoid the big losses. Let the little wins and the little losses cancel each other out. And then what do? We get the big wins. So that's it. That's all we're doing right now. So that's our Dow Jones. That's what we see happening right now. Now let's look at what's going on the weekly right here. We talked about divergence a little bit. Let's talk about divergence again. Compare it to the Dow Jones right here. So we see here, we have a peak right here, one peak. We have a peak right here, two peaks. And then we have arguably like a third and a fourth peak right here, depending how you look at it. So we see here we have our first peak here on blue on the Jewel Thief. Then we see here we have a second peak here on blue on the Jewel Thief, a third peak right here, and then a fourth peak right here. So let's zoom in. And then 1, 2, 3, 4 again on the TJD TDMACD. And this on the weekly, not the daily. So if we see here now, we have a high, then we have a lower high, then we have a lower high again, then we have a lower high again. And I'm just going from this blue stochastic. Every time it rolls over, it's going lower and lower, and it just keeps going down. And the same thing happened on the TJD TDMACD. We have a high, then we have a lower high, then we have a lower high, then we have a lower high. So this is trending down. So we know here we have high, higher high, higher high, higher high. Here we have a low or a high, lower high, lower high, lower high, high, lower high, lower high, lower high. So we have 4 drives of bearish divergence on a weekly time frame. And now we're looking at the weekly chart. So this on a long enough time frame, this is always bullish, right? When's the last time that this was bearish on a weekly time frame? Well, we know we could scroll all the way back here. The last time we were in a bear trend on the Dow Jones on a weekly time frame was in 2008. What was 2008? The mortgage crisis, the global financial crisis, okay? So the 821 crossed to the downside. We break below 200 exponential and simple. We confirm the slope to the downside. And then what happens right afterwards? Bear market. So we get out right here and we dodge 50%, 45% move to the downside. And then again, we see the 821 cross to the upside. We get a little bullish right here. Come up here, retest the 200 exponential and simple. We spend enough time on top of them. And then what happens right here on the weekly time frame? And this works on any time frame, but you have to keep in mind, if you're looking at a weekly chart and paying attention to a weekly time frame, you're talking about multi-year investments. If you're looking at a daily chart, you're talking about probably, months to years investments. If you're looking at a 4-hour chart, you're talking about probably days to weeks investments, maybe months. If you're looking at a 1-hour chart, you're talking about, days to maybe a week or hours to a week. So it's all relative to what time frame you're looking at. So if we know right here, and I'm going to make this big because when we zoom out, it's going to get real small. This was in 2011. We entered into a bull market. And then from 2011 till current day, we never exit on a weekly time frame because it's bullish the whole time. So that's 12 years. 12 years bullish. And where are we at from there? 219%. And this is a stock. It's not some bullshit crypto. This is, an index that represents like the U.S. economy's biggest companies. So now what are we paying attention to? Well, we're paying attention to in the shorter time frames, which here, this was once again, look right here. This was our CVD dump right here. That was our daily circle that we put in. Remember that? Well, look what the weekly told us beforehand. The 821 crossed down right here. And then what happened? CVD dump. And then this was our daily entry right here. Now this is our weekly entry. So if we were looking at this on the weekly time frame, it told us to get in right here at 25.31, 25.312 rather. And then what happened since then? Well, if we got in right there, we rode it up here. I'm going to turn off the drawing tools again. Rode it up here, 821 crossed the upside. It's green the whole time. And now look what's happening right now. What is this? What are those? The 821 is getting ready to cross the downside. If we do not reclaim 35,300, this is going to turn red and we're going to go to the downside. And then what's the most likely thing that happens when this crosses to the downside? Well, we cross the downside right here. We retest the 200 exponential and simple. In this case, we overshoot it. Okay, let's look at the next one. When we cross the downside right here, 821 cross the downside, we retest the 200 exponential and simple. We slightly front run it. Let's look at the next one. Here we see 2 in a row. Cross the downside, retest 200 exponential and simple. Cross the downside, retest the 200 exponential and simple. Let's go over here. Cross the downside, retest 200 exponential and simple. These are 2 little guys right here. We don't worry about those little guys. We got in, we got out. That's fine. And then here, same thing. 821 cross the downside, retest 200 exponential and simple. Retest 200 exponential and simple. Bear market, get out. So what is the most likely thing to happen that happens 90% of the times that we just looked at? Well, if this cross is red and pink, the most likely thing to happen is we're going to retest the 200 exponential and simple. So where does that put our target at? On the weekly time frame? It means the most likely place we're going to come down to somewhere around here. And where is that on the Dow Jones Industrial Average? You know, assuming it takes a little time to get there. Oh, I already have the box in place, so we don't even need this box because we already got a box. It's right here. It's like 30,000, 29,000. So we know with certainty that in order for a bear market to happen on the daily time frame, all those things we discussed have to happen. We know that every time the 821 on a weekly time frame cross the downside, we retest the 200 exponential and simple 90% of the times that we just looked at. So that's our target to the downside if we get the 821 cross. So we know in order to invalidate this cross, we need to close back above 35,291. If we close back above it, we avert the cross the same way we did right here, and then we can continue to the upside. But we know we have 4 drives of bearish divergence, and we know the same way that Bitcoin topped out on 4 drives of daily divergence, and then 821 crossed the downside, and then we retested 200 exponential and simple, and then we potentially go into a bear market afterwards. Clockwork. We can do this on any asset. We can do it on literally anything, and it works. We don't have to change the way we're doing it. We don't have to guess. We don't have to say, well, maybe this. Well, I don't know because the rates and Jerome Powell and I don't know because Russia, and none of that matters. We don't give a shit about any of that because we have a clear, definable way with targets to the upside and downside. We have invalidation points. We know based on divergence. We know based on all these different things. And that's what we want. This, trading is quote unquote a game, but in order to play a game, you got to know the rules first, right? I mean, if somebody just handed you a football and said, all right, man, good luck, and you're on a field with a bunch of other dudes and everybody's wearing pads and helmets and you just hear a whistle blow, if you don't know what the purpose of the game is, if you don't know the rules of the game, I mean, are you going to do well? Are you going to know you're about to get clobbered by a dude that weighs 400 pounds? You know that you're supposed to pass the ball to somebody? You know you're supposed to go to the end zone? No, you got to know the rules. You want to play the game, you got to know the rules. So that's what we do. We define the rules and then we can play the game. See, the problem is with trading, with investing, is people play the game, they don't learn the rules first. So that's what it's all about. It's all about learning the rules. And there's tons and tons and tons of little rules. You could play football by just knowing a bunch of the rules. Maybe you don't know what happens if you go into like triple overtime in a game. Maybe you don't know what happens if, a pigeon lands on the field or a squirrel runs across the field. There's going to be some rules you don't know. Some abstract, weird little rule that happens every once in a while. That's fine. You can always learn extra little rules here and there. What happens if some dude takes his helmet off and hits another dude with it? Does the play stop? Does the ref blow the whistle? Does he get thrown out? Is there a fight? I mean, who knows? I mean, there's a rule for it, though. But you don't have to know that rule to play the game. You have to know these rules to play the game. And that's what it's all about. You learn the core, the principle, the foundation of trading and investing based on technicals. And then afterwards, we worry about all the little bullshit. But if you don't learn the rules that matter in the beginning, it doesn't matter if you know what happens when you go into triple overtime, in a championship game and it's raining out while there's a squirrel running across the field and the referee's blowing the whistle. So anyway, that's what I'm looking at. That's what I'm paying attention to. That's why it matters. That's why this works. That's why this is functional. Let's go to the SPY real quick. See what the SPY is telling us. Same thing. Massive uptrend on the daily coming out of the CVD. Blue means good. And now what's going on right here? We're below 200 exponential and simple, trying to save the trend. It's starting to flatten out. We had the 821 cross the downside right before the dump. Now we need to save this trend. We need to close back above 442 for long enough that these stay positive. We need to get the 821 cross back to the upside, and then we could potentially go to new highs. Let's look at the weekly chart and see if the SPY is telling us that we're in an unsustainable trend, that we need to be careful right here. Again, we see a high right here. Here we see a higher high than this previous high, and then a third higher high right here. Here we see a high on our indicator oscillator, a lower high, and then a third lower high. Same thing here. We see our high back here. We see a lower high. We see a third lower high. Triple bearish divergence on the weekly. And then what do we know on the weekly? When the 821 crossed the upside, they turned green back here. That was at $292. And now look what's happening right now. We're potentially going across 821 back to the downside. Turn red. And that's at $454. So if this crosses to the downside right here, if we don't get back above that, save the trend. We know more likely than not, if we cross the downside here, we retest 200. We cross the downside here, we retest the 200. We cross the downside here, we front run it slightly, but we retest 200, retest the 200, retest the 200. Bear market on the retest, same thing. So we have triple bearish divergence on the weekly, and we know that if this crosses to the downside, we're going to go down more than likely, based on statistics, math, and facts, to $351 to $335, or multiply that by 10 if you're looking at the actual S&P. But essentially, clear, definable ways to measure targets to the downside, where we want to buy, where we want to sell, where we want to de-risk, where we want to get out of the way while everybody else gets hit by a freight train, while they park their cars or try to make it across the tracks before the train comes. We're just sitting in our car eating popcorn, just watching the show, because we might not be right. There's a possibility that we're not right, that this trend gets saved and then we go to the upside, we go to new highs. But you know what? We know exactly when we're going to buy back in. Once we get back on top of 821, once they cross back to the upside, we start continuing. That's fine. So maybe we miss out on from right here where we're at right now to right here. So we miss out on 2.78%, but we potentially dodge 20% to the downside. So do you like the risk reward on that? If I told you, hey, if you give me $2, I will save you from losing $20. That's a pretty good deal. That's a deal right there. If I say to you, hey, we're going to flip this coin, okay, call it in the air, and if you're right, I will give you $20. But if you're wrong, you got to give me $2. Are you going to flip that coin as many times as you can? Are you going to sit there all day long and take my $20 bills like I'm an ATM? Yes, of course you are. Of course you are. That's risk reward. That's the ideal setup. That's what we want. So we risk a 2% move to the upside and we're wrong to gain 20%, or in this case, not lose 20%. And that's risk reward. So the trend is giving us a probability of success above 50%. It's giving us, instead of flipping the coin 10 times and you're right 5 times and I'm right 5 times, because it's statistically a 50% chance, instead, trading with the trend makes it so that when we flip that coin, you're right 6 times and I'm only right 4 times. So that gives you an edge. And then by using risk reward, in this case, 10 to 1, it's not always going to be that good. Maybe it's 2 to 1, maybe it's 3 to 1, 5 to 1, 7 to 1, maybe it's 100 to 1, whatever. You take the risk now and the payout is exponentially bigger than the loss. So if you have a 60% chance of success now, and we flip that coin 10 times, and then each time you make $20, but each time you're wrong, you only give me $2, but you're right 6 times out of 10 now instead of 4 times out of 10. So now your 6 times that you were right, you get $20 a time. So now you have 120 of mine dollars. But you were wrong 4 times too, but you did only have to pay me $2 each time. So I have 80 of your dollars. So then we net out the 120 and take the 8 away from it, and you're up $112. So are you just going to walk away now? Or are you just going to try to sit there all damn day long and flip that coin and just take money from me like ATM, taking 20, 20, 20, 20, 20, 20, 20, 20. Here's your $2. 20, 20, $2, $2, $2, 20, 20, 20, 20, $2, $2. That's what the game's all about. That's what technical analysis is all about. We don't have to be right all the time. We're allowed to be right 4 or 6 times and be wrong 4 times, because that's our probability of success. But the problem is that people don't understand that these are the key fundamentals to being successful in the game. And then we can add on top of that solid foundation that we have built based on trend and risk reward, we have to have position sizing. So what is position sizing all about? Well, if you have an account with $100,000 in it and you have a 60% chance of success, and if you're right, you pay me your $100,000, or I'm sorry, if you're wrong, you pay me your $100,000. But if you're wrong, if you're wrong, you pay me your $100,000. But if you're right, you get back $2 million from me. You have a 60% chance of being right, but you have a 40% chance of blowing out your account. So you get one coin flip to be right. So that's not good. You have a slight advantage. You have a higher risk reward, but you only get one shot. So position sizing is about ensuring that you get enough coin tosses that you're still playing the game when you're right. Because you could go on a losing streak You could go on a winning streak, but if you go on the losing streak before you go on the winning streak, you might be out of the game. Or if you go on a huge winning streak and then you go on a losing streak and you're not properly position sizing, you get wiped out. But you were going to be right anyway. So now we'd say, okay, we're going to divide up our account into 10 lots. So now you have $100,000. You put $10,000 on each bet. So now you could be wrong 3 times. You could be wrong 4 times, 5 times, 6 times in a row. And you'll be down. But then when you hit, you get it all back and more. And then all of a sudden your luck turns. And now, you make that big payday, big payday, big payday. It's not as big as if you just busted your nut one time. But if you bust your nut one time and that's it, you're out of the game. So maybe you want to divide it up into 100 bets, because you could lose 10 in a row. You could be wrong. You could call a coin toss wrong 10 times in a row. It's possible, and you get wiped out. But you're not going to be wrong 100 times in a row. It's statistically impossible. I mean, not impossible, but you got a better chance of getting hit by a meteor. So there's that fine line between, do you need 100 coin tosses, or do you want to do 1 coin toss? That's the difference between position sizing. So now we have the 3 core principles of trading or investing: position sizing, probability of success, and risk reward. And if you master those 3 things, you're set. That's it. That's all you need. You're going to be successful as long as you stick to them. So you need to be disciplined. You need to know what are your stipulations. How are you determining risk reward? How are you determining, probability of success? And how are you determining your position sizing? And if you do all those things and you can clearly define it, you could write it down on a piece of paper, and a normal person could look at it and say, oh, okay, that makes sense. You're gonna divide up your account into, 20 lots. That way you get to take 20 attempts to be right. And you're only going to take attempts where if you're right, you make twice as much as if you're wrong. That makes sense. 2-to-1 risk reward ratio, 10 different lots, so you can make 10 bets or 20 bets or whatever. That makes sense. And then after that, how are you going to get an advantage on the market? Okay, you're going to trade with the trend. All right, perfect. So now you have an advantage of probability. You have an advantage of position sizing, not getting wiped out on just one bet, but you're not making your position so small that you're not making gains quickly. And then, of course, on top of that, you have your risk reward. And again, you master all those things. You make them clear and definable. You put them down on a piece of paper or in a notebook or a dry erase board, or, you just tell your wife, that's your trading plan. That's it. We got a trading plan now. We just built us a trading plan together on stream. And it took us, 1 hour to do it. Good job, guys. Congratulations. I just literally told you the secret of tens of thousands of hours of trading. Things that people pay hundreds of thousands of dollars to learn, either by getting wrecked in the markets or by buying a course or whatever. And all you had to do is just listen to my voice and my horrible analogies on YouTube for 1 hour. Congratulations. You all just got a 1 hour masterclass on trading and investing. Give yourself a pat on the back, because if you're still listening right now, your likelihood of being successful in markets, in investing, in trading, scalping, whatever it is, just went up substantially. Congratulations. If you have any questions, feel free to drop them in the chat. I will engage with you guys for a minute, and then we'll keep running down the line. And also remember, if you are just tuning in, you can watch this later on YouTube. You watch it back as many times as you want. Fast forward. You watch it in slow motion, 1.5 speed, 0.5 speed, whatever you want. But remember, no matter what you do, it's not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. CW. Thanks, brother, for sharing. Okay, I already got to that one. Ban the bot. Got that. America's Finest says, thanks for streaming. Always interesting content. For sure, brother. Yeah, definitely. I do it for you guys, man. CW, fantastic coverage. Heading out, but we'll review. Thank you, good sir. Good to see you, brother. I'm sure you're gone by now. But all right, so let's keep ripping here on traditional stocks, and then we're going to jump into our cryptos. We will look at the DXY, the TNX. I will answer any questions, and then, yeah, that'll be it. So IXIC, Nasdaq. Okay, so what's going on with the Nasdaq? Same thing, but now look, what's different on this chart? I'm sure you can see it. You can catch it easy, right? Been in an uptrend this whole time. It was blue, dabba dee, dabba die. And then look, what happened right here? What are those? The 821 crossed the downside. The 200 exponential and simple have rolled over. What is that? Say it with me now. On 3. 1, 2, 3. Bear market. The Nasdaq is in a bear market. That is not good. Not good. And then if we look at the weekly, what do we see here? This is giving us a little clue as to what the other index is doing. This one's weaker than the other indexes. We see here 821 on the weekly cross, 821 on the weekly cross, retest to 200, retest to 200, retest to 200. So 821 on the weekly just crossed. So what's likely to happen? Retest to 200s. So where's the Nasdaq headed next with a high probability of success? Nothing's sure for sure. There's no facts. There's no 100% in these markets. But we know with a high probability, Nasdaq is probably going to intersect with the 200 exponential and simple, somewhere around 10 or 11,000 roughly. And we're breaking down from key support. We're getting the 821 cross on the weekly. We have triple bearish divergence on the weekly. 1 drive, 2 drive, 3 drive, 1 drive, 2 drive, 3 drive. Same thing, and it's rolling over. Honkiness says, how do you know when divergence has played out? It's playing out right now. You know, because the divergence is telling you the trend is unsustainable. And then what do you look for after that? You look for a violation of key levels, which in this case, we violated the 821 cross on the weekly. We violated a key support right here. We started going from putting in higher highs consistently. We have a high, we have a higher high, we have a higher high. And then we come down, put in a low. And then what do? We put in a lower high. So that's a trend switching. And then the 821's crossing. And then the bearish divergence is playing out. So then after that, we're looking for key support. So we have key Fibonacci levels we're looking for potential buys. Now we're looking for bullish divergence for potential buys. We're looking for the 200 exponential and simple for potential buys. But right now we know we're in a bear market. So we're actually not looking for buys anymore because the trend has changed now. So the triple bearish divergence has played out on the weekly. And now we're not really looking for buys. We're looking to just sit on the sidelines, or we're looking for sells. Here we were buying the dip the whole way up. And now here we're selling the rip. So when we get back down here to 200 exponential and simple on the weekly, then we could pay attention. But we know on the daily, we've just crossed into a bear market. So, we want to sit this one out. We want to de-risk. We want to eat our popcorn and just watch people get smashed by trains all day long. Just getting crushed by trains, losing everything because they're idiots, because they don't have a defined trading plan. They don't know what a bull market is. They don't know what a bear market is. All they do is know what Jim Cramer says. It's already down 20%. That's a buy. Well, a lot of companies go to zero. So if you buy when it's down 20% and then it goes to zero, it's not going to look good. Your account's not going to look good. So here's the Russell, the last of our main indexes. And we know this is obviously the shittiest one, the trashiest one, the most garbage one. 2,000 worst stocks after the good ones, basically, that are publicly traded. This is our trash bag stocks. This is our AMCs. This is our just garbage that still exists, but it's basically zombies with a couple good ones in there. So we know what happened here. We turn off our drawing tools, confirmed a bear market right here. Confirmed it. 821 crossed the downside right here. Came down to the 200 exponential, tried to get back above it, couldn't do it. 200 exponential and simple rolled over. And now what? Free fall. It's completely melting down right now. I mean, this is literally, I call this the bloody waterfall. Okay? Because it's just pure red, just falling off a cliff. And it's getting stronger and stronger and stronger. Here, there's a little waterfall. There's some blood in the water. A little shark bite. And now here, it's just getting bloodier and deeper. And if we look at it on the weekly, we'll see the same thing. We see the 821 has already crossed down to the downside. We already got that 821 cross. This one's ahead of the Dow Jones. It's ahead of the S&P. It's slightly ahead of the Nasdaq. And look where it's almost already down to. We are almost down to 200 exponential and simple. So are we just going to buy this and get anxious and just immediately jump back in? No, we need to wait for the market makers, the leaders, the strong ones, the Dow Jones and the S&P, see what they do. Because we know this one's the weakest. It's the weakest for a reason. You don't just go to the horse race and say, oh, this horse is 50 to 1. I'm going to bet on that one. Why are you betting on that one? There's a reason it's 51. Because it's the shittiest horse. It's only got 3 legs, my dude. It's got gray hair. It's about to get turned into glue. This is its last race before it retires. And it literally said, hey, we're turning this horse into glue after this race. But if you want to bet on it, we'll give you 50 to 1. You want to bet on that? You want to bet on, this is the glue horse right here. You want to bet on the Russell? No. Fuck that. It's about to be glue. It's about to be glue. So that's the old Ruddy. All right, so let's look at the VIX. So we saw the VIX was breaking out of our clear defined area. Oh, sorry, it's on a shorter time frame. So we know it broke out of our clear defined area. We have our descending trend. We have our horizontal trend. We know when we get into the red area, that's probably the market bottoming. We know when we get into the green area, that's probably the market topping, or the other way around. We know we were in this long descending channel right here. We're in the neutral zone. We broke out of the channel, couldn't sustain it, came back down, put in a higher low, came back up, put in a higher high, and now we're starting to build a new trend with a breakout. And this new trend is to the upside. So we had a descending channel, now we have an ascending channel. So what we expect to happen? Well, we already broke out and hit the measure move, which is from the bottom of the channel to the top of the channel. Maybe. I don't know what that measure move. Well, it's a little baby measure move apparently. It should have been bigger than that, I guess. So we didn't hit the full measure move yet. But anyway, oh, that might have been for the triangle. That's what it was. So now here we have a high, then a low, then we have a higher high, then we have a higher low, then we have a higher high. So we expect this to come back down and put in a higher low once again. So that's a trend to the upside. And then we just expect this to keep chopping to the upside, moving up here. And that's going to correspond with the volatility in the S&P is going to correspond with probably the price going much lower in the S&P, which we know is potentially happening because we're reversing the trend on that based on our moving averages. So that's the VIX volatility. Let's look at U.S. oil. So again here, look, we hear all kinds of people talking about crazy stuff about oil. You know, Kathy Wood said oil was going to $12. It was going to $3. Electric cars are going to rule the world. You know, all this stuff. But we know right here, we crossed the 200 exponential and simple to the upside at $46. Now we're at $87, up 100%, probably going much higher. We can go to our weekly time frame. Don't mind that little wick. It throws everything off. We know that oil was in a bear market on the weekly from 2014. And we know here we try to confirm back to upside, found some support, chopped around, bear market. That was CVD. Everything shut down. And then what happened right here? In January of 2021, 7 years, oil was in a bear market. We didn't want nothing to do with it because it was trash. Oil was trash for 7 years. And then what happens right here? 2021, February, we flip back to the upside. 200 exponential and simple, blue slope again. For the first real time, I mean, there was a little chop through here, but that's it. These are the small wins and small losses. We don't care about those. Those X each other out. We got out for the big loss, and now we're in for the big win. And now where's it going right now? Well, let's look at the monthly, see if the monthly is telling us anything. Oh, hang on now. So let's look at this. What is this? What is the monthly saying? So the monthly was in a bull market from 2001 till roughly, you know, somewhere around that 2014, 2015 area. And now what happened right here? What is happening on the monthly? We're reclaiming the 200 exponential and simple on the monthly. We're above it. We're putting in a cycle high, getting ready to retest the previous highs of like $100 to $115, possibly the all-time high of $136. I mean, is this a bull trend right here starting or reclaiming the bull trend before a massive move higher? Well, that can never happen, right? How's oil going to go to $100? No one will be able to afford gas, or $130 or $150 or $200 or $250. It's not possible, right? Well, maybe not. Maybe some crazy event is going to happen. Maybe some weird thing is going to happen. A bunch of oil, you know, fields are going to catch on fire. Maybe there's going to be super demand for oil because all of a sudden, you know, we have some new thing that we need oil for. Or maybe the supply gets hurt. I don't know what's going to happen. I can't tell you what the fundamental thing is going to be. But what I can tell you is this chart is telling us that oil is just now starting into a massive uptrend. So what happens? Oh, electric cars don't work. They're too expensive. They're, you know, subsidies go away. I don't know. I don't know what it's going to be. But I'm telling you right now, we're going to need oil into the future. And based on what this is telling us, probably a good time to be in oil. Maybe not right this second. Maybe it pulls back to 60. Maybe it pulls back to, you know, 59, something like that. But this looks like the beginning of a long trend on a monthly time frame. But I'm sure Kathy Wood's right. The oil will probably just be at $12 soon. But she did just lose everybody's money. And all we've done is made money. So, I don't know. Maybe don't listen to Kathy Wood. 10-year treasury. Let's look at the same thing. And look at the consistency. We just do the same thing over and over again. We teach this to a child. You don't even have to trade or invest. You could literally teach a 6-year-old kid, hey, you know what colors are? You know what blue is? You know what green is? You know red and pink? Sure, when this happens, come get your dad or your mom, whoever's listening, or your bot. If you're, you know, train your little bot child to come tell you or whatever. I don't know, bot clone. I don't know what bots do when they reproduce. I assume it's still considered to be a child. Your little nanobot. You train your little nanobot to come get you. It beeps at you. Beep, beep, beep. And then you come over and you say, oh, look, bull market. 10-year treasury looks like a bull market to me. Bear market. Right before December 2018, bear market went from 3% down to 0, down to 0.39. And now here we confirm back to the upside. Everybody else is bearish. Rates going to 0. They're going to 0. They can't raise rates. Rates can't go up. 10-year treasury can't go up. Bonds are in a bull market. What did we say? See you at. I mean, we called these targets out perfectly. And then, we factor in our patterns. We have cup and handle pattern. We have reversion to the mean trade. We have all this stuff going on. We don't even need to look at any of that because we got the trend right here. We don't need to look at the bullish divergence off of the lows right here. We don't need to look at any of that. None of that matters because we already had this. It's only when we put all these things together that they get exponentially more powerful. If we look at the trend, we look at the oscillator and indicators also. We could look at divergence to help pick out the bottom. We could look at the 821 cross to get into or out of the trend on like shorter time frames or scalps or whatever. But the overall trend is what we're looking at because that gives us a higher probability of success. So now here we are back in a bull market. Let's look at our weekly time frame. What's happening now on the weekly? So the weekly, now keep in mind, this is the 10-year treasury yields. So this is opposite of the bonds, basically. So we know back in 2019, this went into a bear market. And then we see the 821 crosses in green right here. We retested 200 exponential and simple. We consolidate. And now look where we are right now. We're reclaiming those levels. We're back on top of 200 exponential. It has a positive slope again. We're at the 200 simple right now. And we're a couple days away from closing. Well, we're about to start a new week. We close this a couple more times up here. And then the pink flips back to green or blue. And then we have a couple blues. And then what happens? Beginning of a bull market on a weekly. Let's look at the monthly now. What's going on the monthly? We've been in a downtrend on the monthly since confirmed the 200 exponential and simple right here across since 1991. So what does this tell us? It tells us the rates have been in a bear market since 91. So that's 30 years. And what does that tell you about the bonds? Well, the bonds have been in a bull market for 30 years, arguably 40 years. So we know as long as these are bearish to the downside, we're still in a bear market. But what's happening right now? We're seeing the green cross to the upside. So the daily is telling us that we're potentially entering into a bull market, or we have. The weekly is telling us that we're potentially entering into a bull market or very close to it. The monthly is telling us we're at least going to retest these levels. So what are those levels? 2.6, 2.7%. So that's our target. Maybe this happens again. We get up to it, we get rejected, we go down. But more than likely, we get up to it, consolidate around for a bit, and then maybe we flip it back over because the slope is slowly getting flattened out. As we go down and down and down, we come back up to it, test it, we get rejected, we go down lower. But now we can start looking at, some of these other signs telling us, a bunch of green histograms, cross above the slope line, cross above the zero line, hard buy signal, coming out of the bearish control zone, Stokes are angled to the upside, about to enter into the bullish control zone from the bearish control zone. So we know more than likely we're going to retest 2.7 very soon. And then after that, we'll have to see what happens. But if we turn on our drawing tool for a second, we could see basically, man, it's so convoluted. We could see basically we've been operating inside of this channel right here for the last 40 years. So more than likely, we're going to stay inside the channel. So where's the channel at? Up here at our target at like 2.7, which lines up perfectly with the moving averages as well. So that's what we're paying attention to. Just consistent. Looking for our targets, looking for our probability of success, looking at what the trade's going to do. So when people ask me, hey, is now a good time to dollar cost average into bonds? Should I buy bonds? I'm thinking about investing into bonds because the stock market's looking kind of sketchy. Does not look like a good time to me to be in bonds. It looks like the worst time. Any time for the last 30 or 40 years, sure, bonds probably were a safe bet. Right now, me, no thank you. No thank you. All right, let's look at the DXY, dollar index. So this is the dollar not compared to assets, but compared to other people's currencies. So what is this telling us? It's telling us there's a basket of currencies that we're comparing the dollar to. When the dollar is strong, it means we want to be invested in the dollar, or if you're going to be invested in assets, you want them to be, American assets, dollar denominated assets. But if the dollar is going into a bear trend or it's going down, you want to be in the other foreign assets or foreign denominated assets. So, you know, obviously this isn't the basket of currencies is not all currencies around the world. It's, you know, 6 currencies, primarily like the British pound, the euro, the Canadian dollar, and a couple other small ones. But the fact of the matter is, this is giving us a broad scope of the dollar in relation to those other currencies. So let's look at the dollar on the daily. Bear market starting when? May of 2020. Bull market starting when? August 2021. So the dollar is bullish. Everybody else was saying the dollar was bearish. I was saying the dollar is bullish compared to these other currencies, and nobody's even talking about it. Here we see a low, a low. Here we see a, actually we don't see it on this time frame. Sorry, we have to go to the weekly, I think. My bad. My B. Got ahead of myself there. Here we see we have a low right here on momentum, low on price action. Here we have a lower low on price action. We have a higher low on our momentum oscillators. And then here we see basically same low right here, but we have a much higher low on our momentum. So we see we have a low, we have a higher low, we have a third higher low. Here we see we have a low, we have a lower low, we have the same low again. And then let's look at this one. Here we have a low, here we have a slightly higher low, or again, same low, and then we have a higher low again. Here we have a low, a lower low, and then the same low. So that's, once again, triple bullish divergence, telling us we're running out of steam to the downside. The trend is unsustainable to the downside. That's bullish divergence, 3 drives of it. And then what happens shortly afterwards? 821 crosses to the upside. We reclaim the 200 exponential and simple on the weekly. So we've been in a bear market on the DXY since 2020. And now we've reclaimed those levels and we're entering into a bull market. So now we're just retesting these levels, going parabolic to the upside, as now the dollar is strengthening compared to these other currencies. Now let's look at the monthly. And again, everybody else hates the dollar. Dollar's garbage. They're printing it like crazy. I don't care. I don't care about the fundamentals. I don't care about what people say. I care about the technicals because they work every time. And if they don't work, they tell us ahead of time. There's breadcrumbs. And they say, hey, the 821's crossing the downside. Oh, we're losing the slope on the 200. Maybe it's time to get out. We don't get any surprises. It happens the same way every time because we have clear, definable way to measure a bull and bear market. Most people don't have that. They don't even know what that is. They just say, well, Jim Cramer said to buy. Well, Jerome Powell's printing all the dollars. Who cares? This thing's been a downtrend since 1986. Obviously, because we're on the monthly now, the 200 exponential and simple are not populated for the first portion of the chart going back to 80s. So they finally populate in 2002. And then what happens? We've been in a bear market since 2002, or technically 2003. The 200 exponential and simple across the downside, negative slope, red and pink. And then what happens right here? We start to reclaim them. We try to cross back to the upside here, try to enter in a bull market, cross back here. And then what happens here? The 200 simple actually goes negative again, but the 200 exponential never leaves its slope again. So from here on, basically from 2015, technically, we started to confirm back into a bull market. And then what happened right here? Right here, for the first time in 30-something years, the dollar was bullish again. Now we had a little 821 cross back to the downside and a retest. But what happened? We had a low, we have a higher low, we have a higher low, we have a higher low. And now here we confirmed and are pushing back to the upside. The 200 exponential and simple on the monthly are bullish. The 8 and 21 have crossed back green to the upside. So for the first time in 40 years that this chart has existed for, we are in a bull market on the monthly. So what does that tell us? It tells us the dollar is strengthening compared to other world currencies, other, countries' currencies. So while everybody else is saying, get out of the dollar's trash, dollar's going to zero, buy assets, invest, inflation, the dollar's garbage, they're printing too much of it. We know, based on technicals, based on the charts, we know that cryptocurrency is going into a bear market or very close. We know the stock market is going into a bear market or very close. We know that the DXY is going into a bull market, confirmed already on a monthly time frame. We know that the 10-year treasury is going into a bull market on monthly time frames. We know that, weekly for sure, but monthly close to it. We know bonds are going into a bear market on weekly, potentially longer time frames. How do we know all these things? Well, it's easy. Blue means good. Green means good. Red means bad. Pink means bad. That's it. That's all we got to do. It's easy. Make it easy. Don't got to be any harder than this. The other stuff is great. We put in the divergence, we put in like all these other little tools in our tool belt, and we can, use them to have an extra advantage on the market. But right now, we don't need all that. We'll keep it simple. And then you build on top of a solid foundation. The same way you would build your house on a solid foundation. You don't just start building the roof first. You don't, start building your bedroom first so you have somewhere to sleep. No, you build a foundation. You take your time. You put in the work. And then eventually you get to sleep in your bed knowing that your house is not going to fall down when there's a windstorm, or, a bear is not just going to run up in your room because you didn't build walls yet. You just built a bed and a little lean-to. So here we're looking at gold. Gold on the daily, bull market from back here at what, 1,300? And now what? We're basically bear market confirmed back here. Now we're trying to save the trend right here, but we know we're at an inflection point. We're very close to gold going back into a bear market. Now, could it save the trend right here and start moving back to the upside? Sure, it definitely could, but right now it looks like a bear market. If we go the weekly, we know we confirmed into a bull market right here around the same area on the weekly, 1,300, and we know that if this breaks, which we are underneath the 821, we know when this breaks down, we're more than likely going to retest the 200 exponential and simple. So we know there's a very high likelihood that gold is going back down to $1,600. And if we confirm and save this trend and start moving back to the upside, that's fine. We can get bullish on gold. We can be all about that gold again. But right now, we're either going to, chill out for a little bit, not keep buying gold, not necessarily going out and selling our physical gold, but maybe hedge ourselves. Maybe just not buy anymore right now. Maybe just kind of wait it out and see what happens. Let's look at silver. Got that silver. Looking terrible. Look, we had a great little run up right here, bull market. And now look, bear market. We're below 200 exponential and simple. We're at key support. Looks like we're getting ready to break down back into the teens. And if we look at the weekly chart right here, we know we had a nice run up right here. And now what are we doing? We're basically at or retesting the 200 exponential and simple. So we've almost already reached it. Where's that at? $21. Where's 200 simple? At $19. Is silver going to be a teenager before it keeps running to the upside? Probably. Probably going to depend on what gold does, honestly. Let's look at uranium. You guys know I love uranium. I was all about that uranium. I was talking about it when nobody even knew what it was. Now everybody's talking about uranium. Uranium's the most popular thing there is. Everybody wants that uranium, that yellow cake, that nuclear power. Sure. But what's happening with uranium right now? Well, we went into a bull market right here. This is URA ETF, uranium ETF. At 1059, we went into a bull market. And look, beautiful move to the upside. And then what happened here? The 821 crossed the downside at 28 after a 3x. And now here, what's happening? We're below the 200 exponential and simple, and the slope is flat. Looks like it's about to roll over. So it looks to me like this is about to go into a bear market. That's on the daily. So if we look at the weekly, what's going on here? Uranium was in a bear market since like 2000 and basically 10. This is 200 exponential and simple. Been in a bear market forever. What happened right here? Well, in 2020, January 2021 rather, we confirmed back on top of 200 exponential and simple, flipped them back over blue. So this is a bull market. But what does that mean? Well, it's good for sure, but the 821 just crossed the downside. So now we're in a bull market. So what do we want to do? We want to buy the dips. The same way that we were selling the rips the whole way down, we're buying the dips on the way back up. So when we look at this weekly time frame, we say we want to buy somewhere around $17.42 to like $15. We want to reinvest around those levels or add to our positions for long-term upside potential. And then the monthly chart's really not going to give us anything on this. We crossed 821 back to the upside. We're basically like holding on to the, there's just not really enough time frame here. But so hopefully you guys get it. I don't mean to be like redundant, just saying the same thing over and over again, but that's how you win. Consistency. You know what I mean? You don't need to throw one fastball. You don't need to throw, one breaking ball. You need to be able to throw the same ball over and over and over again so you can strike people out. You can be efficient. You can be consistent. Hopefully I answered your question there, honkiness. Divergence tells you a direction change, but not at all how much it will drop or rise. Yeah, kind of, man. It tells you that you're looking, the reason they call it divergence is the price action is diverging from your indicator or oscillator. So it's telling you that whatever's happening right now, that there's divergence between price action and the indicator oscillator is unsustainable. So if you're getting bullish divergence, it means soon it's going to stop diverging and then it's going to shoot back to the upside and reverse. If you're getting bearish divergence, it's telling you, well, this is unsustainable. You're not just going to keep melting up. So soon it's going to break back down, and get a pullback. And then what are you looking for? Well, what direction is the trend? Are you getting bearish divergence in a bull market? Are you getting bullish divergence in a bear market? Because then it's probably just reversion to the mean because it's a counter trend trade. But if you're in a bull market, you get bearish divergence, then you're looking to buy the dip, like when it pulls back to the 200 or something like that. And then vice versa. If you're in a bear market and then you get bullish divergence and it pops back up, you're probably looking to sell into the 200 exponential and simple. And that's why I use these is there's, I didn't invent the 200 moving average. It's an old school thing that people have been doing since, the beginning of the Dow Jones, since, the 1800s. People have been using this stuff since people have been charting, since technical analysis has existed. And then the 200 exponential is just used more often for like more volatile assets. So I think pretty much going to call it there. I'll take a quick look at Ethereum, Bitcoin dominance, and crypto market cap. And then we're going to keep this one right around like 2-hour mark. So Ethereum, we're seeing the same thing. This is our daily chart. We retested 200 exponential and simple a couple times. We broke down below the 200 exponential. It is now flipped over red. We're well below the 200 simple, and it's looking red too. Looks very weak. So we know, obviously, if we look at the weekly now, we're probably about to see the 821 crossing to the downside, which we are. So we know the 821 crossed to the upside right here on April 20th when Ethereum was $179. And we know it crossed to the downside on January 10th when Ethereum was $3,699. So all we had to do, get in when it's cheap, get out when it's danger, and we don't have to worry about it. And what's likely to happen? Well, we're probably going to retest 200 exponential and simple. Where's that? About somewhere in between $1,000 and $1,500. So that's our target. Not going to go into like super deep dive on all these things because really it's up to what Bitcoin does. So now let's look at Bitcoin dominance. So what have we been calling out right here? How did I call the top on Bitcoin again? Here's our weekly Bitcoin dominance chart. So this is just telling us what percentage of the total crypto marketplace is Bitcoin making up. So here we have a low right here. Then we have a lower low right here. Then we have a third lower low through here. We're operating obviously inside this green channel. Red is our resistance. And what happened? 1, 2, 3 drives lower. And what happened on our indicator oscillator? Well, we have a low right here. Then we have a higher low corresponding right here. Then we have a third higher low right here. And then same thing again. It's not as clear on this, but essentially we have 3 drives of bullish divergence telling us that we're not going to keep putting in lower lows. So now we're pushing back up. We had a reversal right here. The 821 crossed back to the upside. And now what are we retesting right now? Well, we're retesting 200 exponential and simple. So we entered into a bear market on Bitcoin in relation to altcoins in March of 2021. Since then, altcoins went absolutely parabolic. We retested, tried to reverse the trend right here and failed. And now we're trying to reverse the trend again. So one of two things is going to happen. We're either going to reclaim the 200 exponential and simple and then chop around for a little bit. And then they're going to flip back blue. And then Bitcoin's going to go in a bull market in comparison to altcoins. Now, keep in mind now, this is Bitcoin compared to altcoins. So Bitcoin can go into a bull market compared to altcoins. But what could that mean? It could mean Bitcoin's going down in price, but altcoins are going down in price faster. So it's regaining market cap in relation to altcoins, but it's because altcoins are going down really fast and Bitcoin's just going down kind of fast. So maybe Bitcoin is going down to 30,000, but all these other altcoins are dropping exponentially fast. So Bitcoin goes down 10%, all the altcoins go down 20%. That corresponds with Bitcoin going into a bull market in comparison to altcoins. So that's what we're looking at on this chart. So keep in mind, even though this says, hey, we might be about to go bullish on Bitcoin, it's not bullish on Bitcoin price. It's bullish on Bitcoin in relation to the altcoins. And now let's look at our crypto market cap. So here we have, I'm going to flip this over to the week. That was just the weekly chart. I don't know if I said that. This is our weekly crypto market cap. And now let's look here again at what's happening. See, we have a high right here. Once again, we have a higher high. Here we have a high right here. And once again, we have a lower high. And same thing on the Jewel Thief. Here we have the high. Here we have basically the same high, slightly lower. And then on the TJD TDMACD, here we have a high. Here we have a much lower high. And then again on price action, we have a high and then a higher high. So we have bearish divergence once again. And then here we have the 821 cross, but we saved the trend. And that's fine. But we got out knowing right here that we're in the danger zone. And then we get back in knowing right here that we saved the trend. And then here we get out knowing that we're in the danger zone. And then what happened since then? Well, we had $2.24 trillion in value then, and now we have $1.6 trillion. So if the whole market was doing what we were doing, we just saved the market $600 billion by just doing what we do. And this on the weekly, actually we were out faster than that. So we knew it was coming because of the bearish divergence. This was confirmation. And now what's most likely going to happen? Well, most likely we're going to retest 200 exponential and simple. Where's that? 200 exponential is at 985 billion. 200 simple is at 711 billion. So more likely than not, the entire crypto market cap is going to go down to roughly $1 trillion. So if it's at 1.6 trillion right now, we get out roughly at 2.2 trillion. We know that could have saved the market $1.2 trillion. But instead, we have 8 people watching. And that's why they're all going to be poor and keep losing all their money. And we're all going to be rich, living on islands, having fun. I mean, not that people aren't rich already, but richer, more rich. The richest, one could say. But anyway, that is our total crypto market cap. Do I want to look at altcoins? No, I'm not going to do it. Let's look at MicroStrategy. So we hit our target on MicroStrategy, which was the 0.5. We hit the measure move. And now look, just full on free fall. We got a little pushback up to 0.5. It was crazy when I said $338 because MicroStrategy owns enough Bitcoin that their balance sheet should be worth more than $338. So why is it not? Well, who knows? Maybe Bitcoin's going to go down in value a bunch faster than MicroStrategy goes down in value. Or maybe MicroStrategy is going to go back up in value and revert to the mean of what their balance sheet Bitcoin is worth. I don't know what's going to happen, but I know that there's a divergence between the price action on MicroStrategy and Bitcoin, and it probably has something to do with MicroSailor being, a scammer piece of shit. So, but who knows? And then Coinbase obviously broke down from our ascending broadening wedge. Once it broke down from that wedge, we're just looking for our Fibonacci extension targets to the downside. We hit the 1.382. You guys know I like to watch for the 1.5 or 1.618. So when I was saying, Coinbase under $200, people were like, it'll never go under $200, bro. Crypto, and they make their money off the fees and the percentages, and Coinbase is amazing. And now where are we at right now? Well, we're down substantially from Coinbase IPO. If you bought in when Coinbase was initially offered to the public, that was at $380? 380 or something like that? I don't know. It doesn't matter. And now we are currently at $169. So Coinbase is down 55% since IPO. So now every time it tries to push back to the upside, there's going to be sellers just pushing the price down over and over again because no one has ever made money in this stock by just buying it and holding it because it's putting in literally lower lows every day. So do you want to be invested in Coinbase right now? Fuck no. You want to be invested in Robinhood right now? Fuck no. Anything that looks like this is the worst thing to be invested in. Because there's just all these people, just all they want to do is just get out of their positions. Because they're just losers. Not like at life. They might be good people. And they might win at like sports games or video games. But at investing, they're losers. Because they're just, all they're ever doing is losing money. And they're going to continue losing money. Because this is trash. And if it ever was going to be good, if Coinbase was ever actually going to be good and make people money, we know what's going to happen. The 8 and 21 are going to cross to the upside. And then, if you want to invest in Coinbase, by all means, we'll invest in Coinbase. But right now, we know that only losers buy Coinbase. All right. We did it. We made it to the end. Yay. Congratulations. Hopefully you guys enjoyed the stream today. Appreciate everybody tuning in. Hopefully you guys got something out of it. Maybe you learned something. Maybe you didn't. You got the free class today. 10,000 hours. I mean, way more than that. Hundreds of thousands of hours worth of knowledge crammed into 2 fucking hours of me just running my goddamn mouth. Hopefully you enjoyed it. Hopefully you don't mind that I took the Lord's name in vain. I didn't mean it. Yeah, that's it. So if you guys have any questions, feel free to leave them in the comments section or whatever. We're going to go ahead and call it today. We will do our stream, as always, every Wednesday and Sunday from 8 p.m. Eastern Standard Time till roughly 10 or 11 Eastern Standard Time. I am potentially going to be starting to do a third stream, so 3 streams per week instead of 2. Haven't completely decided yet, but thinking about doing it that way and just doing them each like 2 hours instead of 3 hours. We'll wait and see. If you are interested in joining the group, if you got something out of today's session and want to make a contribution to help support my work, feel free to do so. There's no obligation, obviously. I do these for free, and my work is currently supported by all the people that are in the group. If you are interested in furthering your education and putting some more tools into your tool belt and you want to join the group, you can with a single one-time contribution, which I like to think is pretty damn reasonable. And with that contribution, you get access to our Discord group, get to be a part of the community, and then also you get access to my 2 exclusive indicators. All the other indicators are offered for free. You can look in the description of the video and get those. But the most recent version of the Jewel Thief, which you see me using today, and the moving average indicator, the TJD Master, are exclusively offered to the group members. With that one-time contribution, you do get permanent access to those indicators and any further indicators that I should happen to release to the group in the future. So that's it for today. I appreciate everybody tuning in. Make sure you like and subscribe, share it with your friends, smash up the likey button. Tell your dog, tell your friends, whatever. Tell your wife about the blue and the green. See if she could do the same thing. Let her trade with your account. Whatever you want to do. But that's it for today. Gonna go ahead and call it. It is January 30th. 2022 at 9:40 p.m. Eastern Standard Time. That's it for today, folks. Remember, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. Crypto Trend Trader, and I'm out like trout. Peace.